to thank everybody for coming out today. I'm Patrick Lach. I'm an associate professor of finance here in the School of Business. And I also wear another hat. I am an investment advisory representative. I own and operate Lach Financial, which is a fee-only registered investment advisory firm based out of Louisville, Kentucky. So before I begin, quick disclaimer. This is not investment advice. This is not an offer or recommendation to buy or sell an investment product. And all investments carry risk, and it's the responsibility of the individual to consult with an investment professional before making any investment decisions. So, what I'm going to do is, this is a similar presentation I've given to a student group on campus. A student group asked me to talk about investing, and I told them to send me some questions, and I would address those questions. So that's how we'll structure this presentation. If there's any other questions at the end, I'd be happy to address those. But in terms of getting started with investments, investing is something that intimidates a lot of people because there's so much out there, there's so many options. But really at the core, there's only two types of investments. We have what are called fixed income investments. They pay a fixed amount of money at pre-specified intervals. We often call those bonds. Could also be an annuity. We also have rising income investments where it pays a set amount, but that amount typically rises over time. We usually call those stocks or equities. And so I always tell clients at the heart of it, we have those two types of asset classes. I tell them bonds go in the portfolio for stability, stocks go in the portfolio for returns. And because bonds are there for stability, I like to get stable bonds. And because stocks are there for returns, I like to be a little bit more aggressive on the equity side. So that's my investment philosophy. In class yesterday, I was talking to students about money market securities, and we got onto this topic of, one of the biggest mistakes I see people make is the bonds are there for stability, stocks are there for return. And what people will usually do is they look at the bond side and they'll say, gosh, rates are so low right now. I mean, these bonds aren't really doing anything. And so I want to get a little bit higher returns. So they get more aggressive with the bonds. And they look at the stocks and they say, gosh, the market is everywhere. Gosh, I really hate these big swings. I need to get some more consistent and reliable companies in my portfolio. And they get more conservative with equity to the point where they end up with stocks that are pretty similar to their bonds. And you don't get much of a diversification benefit. So that's why I'm a big believer. Be conservative with your fixed income. Be aggressive with your stocks, with your equities. If you want more stability, don't get more conservative stocks. Just increase the portion of fixed income. If you want more return, do the opposite. Increase the portion of stocks. So those are kind of the basics of basic theories around how I invest and what I look for. So we'll address some of the questions and comments that some students have made. If there's some other comments, I could address those as well. Could also get into a little bit about analyzing a mutual fund, because that's how a lot of us invest, and what are some things I look for in a mutual fund. So some of the questions some of the students asked: what's the best time to invest? What percent of your yearly salary should be invested? And what's the best age to invest if you want a comfy retirement? So what I always tell students is, starting out, shoot for saving 15% of your income per year, especially for a new investor that forces them to live frugally. So in other words, if you made $50,000 a year, aim to invest $7,500. This would include a 401k match. A lot of employers have different formulas for a 401k match. Here at Eastern, it's been a while since I've reviewed the numbers, but here at Eastern, I believe we contribute 8% of the paycheck into we have a 401a plan here. We put in 8%, the state or the university puts in 6%. So we're already here at Eastern really close to that 15% mark, which is really good. But people that work in the private sector, the two most common types of match is it'll be 50 cents on the dollar up to 6% or dollar for dollar up to 6%. Again, every place is different. When I was a doctoral student at Mississippi State, my last year I was a benefits eligible employee. And I didn't make a lot. I made $25,000, but as a grad student, I mean, for me, I was rolling in the money. And they said, do you want to set up the 401A plan here? And I said, no, I'm only making $25,000. It's probably not going to be worth my hassle. And they said, well, we have a good match. I said, well, how good? They said, our policy here is we will match $1.50 per dollar up to 8% of your salary. I said, so I put in 8, you guys will put in 12? I said, okay, it's worth the hassle now. So went through and did the paperwork and got that set up. So I always tell students, number one, if you get a match through your 401k, that's a no-brainer. That is something you need to be maxing out. Because there's the old saying, if it sounds too good to be true, it probably is. This is one of the exceptions to that rule, because an instantaneous 50% return, or I guess with we put in 8, the state puts in 6, that'd be an instantaneous, 75% return? That's a no-brainer. You're not getting that anywhere else. And so that to me is an easy thing that should be maximized. So I tell students, if you're making $50,000 a year, you need to put in $7,500. And I tell them, if your employer has a we'll match 50 cents on the dollar up to 6% of your salary, then you would end up having 9% or $4,500 of your $50,000 going into your 401k. That $3,000 shortfall, I tell them I'd recommend putting that into an IRA. I also tell people only contribute to a retirement plan like a 401k up to the match and then go with a Roth IRA. The reason is I've reviewed a lot of 401k plans. It's very rare that I see one where I believe the administrators are actually acting in the best interests of the participants. And this is being recorded, but I'll go ahead and say it. I have some very, very serious concerns about the investment options that the university is giving the employees here at Eastern. I think our investment options are awful in our 401k or 401a. But once we get through some of these questions, I can get into a little bit more detail about what I look for in investments and to me what makes an investment good or bad. So, but going back to these questions, I think I addressed it a little bit on the slide I just covered, but what's the best time to invest? There's a quote, I believe it's attributed to Warren Buffett. He said, the best time to invest, or the best time to buy stocks is now, the best time to sell is never, or when you need the money. So when's the best time to invest? It's now. It's never too late to get started with investing. What percent of yearly salary should be invested? Is a general rule, I tell people 15%. With my own investment advisory clients, I've actually created a calculator where you input the client's age, you input the amount of money they currently have saved. It gets a little morbid, but you have to estimate how long they're going to live. I usually use 95 if they have a history of longevity in the family. I could ramp that up to 100, 105. Estimate the client's return, estimate inflation, and estimate how much they're going to need in retirement. And with all those inputs, it'll spit out this is a number the client needs to invest every year. So without going through that type of analysis with a professional, I always tell people 15% is a pretty safe rule. So what percent? Again, usually the 15. Again, here at Eastern, we're lucky in the sense that A, they kind of force us into that retirement plan, but B, we're lucky because it's 14% out of the gate. But at other companies where there is no match, I see a lot of people come in, they're not participating in the 401k, and they get behind the 8 ball a little bit, and then they have to catch up, in which case they might need to invest more than 15%. So it's all dependent on the person. What's the best age to invest? Again, the younger the better. The earlier the better, and the more you can invest, the better. And it also depends on how you define comfy. With my students, I got a lot of questions about individual stocks, a lot of them. How long should you wait before a stock rises to sell it? What's a useful method for picking profitable stocks? Can you elaborate on a strategy to invest in stocks that rapidly change versus stocks that slowly change? My answer to all these, people say, how do you invest in individual stocks? The answer is, I don't. This is from a textbook that I use with my students. And in investing, we have a couple types of risk. There's what's called firm-specific risk or unsystematic risk. And then there's market-wide risk called systematic risk. The market risk, we can't diversify that away. But the firm-specific risk, we can. And there's a lot of risks that could be unique to a specific firm, but not an industry. For example, when I was an undergrad, I invested in individual stocks. This was before I knew better. And what was that, or when did that whole Atkins diet craze hit? I'm trying to remember. That was early 2000s. When that diet craze hit, Krispy Kreme was one of the stocks I liked to trade when I was an undergrad. It was a high-flying stock. Anytime they opened a new store in a city, I mean, there would be a line several blocks long. It was a great stock to invest in until it wasn't. And it stopped being a great stock to invest in once that Atkins craze hit. I mean, Atkins killed Krispy Kreme. But if you had a diversified portfolio, for every stock you have where they sell a product that's carb heavy, you could own another stock where they're selling food that is carb free, right? And the rationale of diversification is you could have an event that would adversely affect one company and positively affect another, in which case that event would be a wash. And so that's where we have the firm-specific risk and then the market risk. What's nice about firm-specific risk, we could diversify that away. And that's what's so nice. The more stocks we add in a portfolio, the lower the risk of that portfolio. In finance, we measure investment risk with standard deviation. It's not a perfect way to measure risk, but there's lots of other better methods, but that's beyond the scope of this presentation. The more stocks we have, our standard deviation goes from 49 and it levels off to about 19. And this is actually derived from a research paper in, I believe it's Journal of Financial and Quantitative Analysis. But they did a bunch of simulations. They took one stock portfolios and they figured out what was the average risk of a one stock. And they randomly came up with two stock portfolios. What was the standard deviation? And they did it for 10, 20, 30, all the way to 1,000. And you see how drastically, even at 10, this risk drops pretty significantly. And the more stocks we add, the more the standard deviation levels off to this 19.2%. And we call that market risk or non-diversifiable risk. There's nothing we could do to get rid of that. So this is why I don't invest in individual stocks. Because, again, these are randomly selected one stock portfolios, two stock portfolios. The average return of this portfolio is the same as the average return of this one. So again, in investing, there's no such thing as a free lunch. Risk and return are related. But this is one little exception to that rule. By diversifying, we could actually drastically reduce our risk. In fact, we could cut it in half relative to a single stock, and we don't sacrifice our expected return. Right? Because we have 1,000 stocks. On average, these 1,000 stocks will be just as average as this one stock. So our return, by definition, will be the same, but our risk is half. So that's why I don't fool with individual stocks. I'm not going to take a risk unless I'm going to be compensated for it. And owning a single stock, it's a lot of risk, and you're not going to get compensated for it. So I avoid it. So that's my take on an individual stock. Students have often asked, where do you go to invest? And where do you go to buy stocks? Where do you go to buy mutual funds, etc.? And they also said, what are the charges when you go through a company like Charles Schwab if you're going to invest on your own? So finding an advisor, again, this is where a little bit of biases come in. there's a lot of titles that people will use in this business. I actually have a research study I'm working on right now about this very topic. Currently, in the United States, there is only one title that is regulated, and that is investment advisor or investment advisor representative. Everything else, there are no rules to who could use the titles. Anybody could call themselves a financial advisor or a wealth manager or a financial coach. Those are all completely unregulated. In fact, if you go to FINRA, they'll tell you just that. And it's really frustrating the way we're regulating investment advice in this country, because if you go to FINRA's website, and FINRA is the Financial Industry Regulatory Authority, FINRA basically has a little word of caution to investors. It says, we let people call themselves whatever they want, including these terms, and they list financial advisor, wealth manager, etc. And FINRA basically says these terms are all meaningless, they mean nothing, good luck. So there's also a lot of credentials in this business. It's sad, but the market for investment advice is kind of the wild, wild west. Not only can you call yourself whatever the heck you want, there are, last I checked, there are 150 credentials that can be used. Some of these require intense study. The CFA charter, which is the designation I hold, it's 3 levels to that exam. You have to pass them sequentially. And the pass rates are historically very low. Pass rates for level 1 is usually around 40%. For level 2, it's usually around 45, and for level 3, it's usually around 55. And so people say, oh, so it gets easier. And I say, no, because the level 2 people are only the ones that pass level 1, etc. Successful candidates report spending around 300 hours of study per level. And people that have taken the bar exam tell me that it takes around 250 to 300 hours of study to pass the bar. So the CFA is 3 times that amount of study. You only get 3 letters for that. Unfortunately, there are other designations where all you have to do to get the designation is write a check. And so that's one of my frustrations. Really, the CFA, in my opinion, is the gold standard because of the rigor of the exam, the breadth of the exam. CFP is also okay. I have my Certified Financial Planner designation. CFA is Chartered Financial Analyst. I have both of these designations. In my opinion, and I'm speaking from experience, the CFA designation was 4 times more rigorous than the CFP. And that's coming from the experience of having passed them both. Another very reputable designation is this PFS, which is Personal Finance Specialist. It's through the Institute, the AICPA, American Institute of Certified Public Accountants. It's kind of an add-on to the CPA designation, so you can't get this unless you're already a CPA. In my opinion, those are the only 3 that matter. Also, in my opinion, if you see somebody that's stacking a list of 4 or 5 credentials after their name, anything beyond that, honestly, I don't have a whole lot of respect for those credentials, and a lot of times I think it comes down to simply marketing. I did an interview for WEIU. I'll open up the link. I don't know if we're connected to the internet in here. So if you want to learn more, there's about a 25-minute interview where I talk about some of the things I'm going to discuss briefly. You could find it. It's from Money in Your Pocket on WEIU. Also, easiest way to find it, if you go to YouTube and just search for Dr. Patrick Lach, it's one of the first things that'll pop up. But I cover a lot of the things I'm going to talk about here in a minute in a lot more detail. But in terms of, like I said, in terms of credentials, CFA is the gold standard. CFP is good. Doesn't have the rigor of the CFA designation. And then the PFS is good, but you can only get that if you're an accountant. So those are the only three that matter. If you see somebody with a whole bunch of credentials and none of them are those three, to me it's a sign to walk away. What else do I look for? I look for a fee-only advisor, not to be confused with fee-based. So basically, in investment markets, we have two major groups. We have investment advisors and we have brokers. Investment advisors, by definition, they're regulated under the Investment Advisors Act of 1940. The courts have later ruled that that act implies a fiduciary standard. A broker is not held to a fiduciary standard. They're held to a suitability standard, meaning they're not obligated to act in the client's best interests. Actually, they're obligated to act in the best interests of their firm, which often don't line up with the interests of the client. There's different ways that investment professionals are compensated. Sometimes they'll just charge a fixed fee, where they'll charge you a fixed amount per year. Others will charge you could pay for hourly advice, where if you just say, hey, put together an investment plan and recommend some investments and I'll go implement it. Some advisors do that. It's a service that my firm provides. Other advisors will charge an assets under management fee. Standard's kind of is 1% of assets under management. The other way people could be, so all of those would be examples of a fee-only method of compensation. Commissions are another way that people in this business are compensated. If somebody sells an annuity, I've seen annuities that pay commission rates up to 12%. Meaning if somebody walks in with $100,000 and you sell them an annuity, you can make $12,000 that day if you're a broker. So fee only means they're only going to charge the fixed annual fee, they're only going to charge you hourly fees, or they're only going to charge you an assets under management fee. Now, I say not to be confused with fee-based, because what fee-based individuals do is they say, I don't know if I should charge commissions or if I should just charge a fixed assets under management fee. No, so I'll do both. And so the fee-based advisors, so many people get confused because fee-based, fee-only, just off by one little word, but it's a gigantic difference between the two. So I always recommend fee-only because it eliminates those conflicts of interest that commissions are going to introduce. By the way, that fee-only model, it's the only model that's legal in the United Kingdom. It's the only model that's legal in the Netherlands. It's the only model that's legal in Australia. All three of those countries within the last 3 years have outlawed the receipt of commissions from selling investment products. And the Netherlands has too, a country where drugs are decriminalized and prostitution is legal, or vice versa. I always get them confused. In the Netherlands, smoke pot, have sex with prostitutes, but you can't receive commissions from selling financial products. That tells you where the Dutch government, where they view commissions in terms of damage to society. Here in the United States, it's still perfectly legal to get commissions from selling financial products. So that's why I recommend a fee-only registered investment advisor. Fee-only eliminates those conflicts of interest, and a registered investment advisor is required by law to act as a fiduciary. So that's why I recommend fee-only registered investment advisors. Also, an investment advisor has to disclose conflicts of interest, and they have to keep fees and expenses reasonable. The downside, and this is where people will criticize registered investment advisors. In fact, there is currently, and it's expected to come out any day now, the Department of Labor has a proposal, and it's expected to come out any day, that would require anybody, whether it's an investment advisor or a broker, it would force the brokers to act as fiduciary when handling retirement accounts. It's not out yet. We're recording this on the 30th of March. Probably going to be out any day from now. Critics of that Department of Labor proposal say it's going to crowd smaller investors out of the market. They say fee-only registered investment advisor, it's all good and great, but they're not going to work with people unless they have a lot of money. That's a valid argument. Most won't work with you unless you have $100,000. At Lach Financial, my minimums are about as low as I've seen anywhere. I have a $50,000 minimum. So, solution, find somebody who performs hourly work. You could go to napfa.org to find one. You can go to the GarrettPlanningNetwork.com to find a hourly advisor. And I always tell students, starting out, you're probably not going to have $100,000 to invest, but if you change jobs and you're rolling over a 401k, that'll get you close to that $100,000 minimum. There's a new solution. They're called robo-advisors. And frankly, my opinion of robo-advisors has been declining. My first reaction is this is a great idea. Basically, you go online, you input your information, your age, you answer some questions about risk, about your time horizon, etc. And they will develop a portfolio for you. And at first I thought, this is perfect. This is a great solution for people that don't have the money to go to an investment advisor. And then I've started reading some of the studies on these robo-advisors. And the variation in portfolio, even for the same client, is drastic. There was a study by FINRA, and I'm trying to remember the exact numbers, but it was a 29-year-old, which 29 years old, you should be aggressive. You should have a lot in the stock market. But for this 29-year-old, I think FINRA had this person go to maybe 4 or 5 different robo-advisors. Robo-advisors are what people are calling them. It's just an online investment management platform. The variation in portfolio recommendations. One robo-advisor only had this 29-year-old in 54% equities. The max only went up to 92. Which again, in my opinion, for your average 29-year-old, you should probably be almost all equities. I mean, that 8% in fixed income really isn't going to do a whole lot to help you. So, my opinion, I was really big on robo-advisors when they first came out to smaller clients that couldn't afford a fee-only advisor. With all the other companies that are coming in the marketplace now, it's kind of like target date mutual funds. Target date mutual funds are designed, it's a target date fund because there's usually a year in the name of the fund. And that year is when you anticipate that you'll retire. So the theory with a target date fund was, hey, you don't need an investment advisor anymore. Just get a target date fund, pick when you're going to retire, set it and forget it. Just keep putting money in the fund, and it'll automatically go from a higher percentage in stocks to a higher percentage in fixed income as you get closer to that date. Problem with any good idea is Wall Street usually comes in and ruins it, and that's what happened with target date funds. There were so many other variations that were out. The wide array of what was available was mind-boggling. There were a lot of, in the 2008 crash, there were a lot of target date funds that were designed for people retiring in 2010, 2015 that dropped 40 or 50%. So target date funds has become, there's so much variety that you're back to square one where you need to hire a professional to go through and analyze those funds and make a recommendation. And I feel like we're kind of there with robo-advisors now because there's so many new companies entering the marketplace that there's such a wide range that you're back to square one where you need to sit down with a competent professional that can talk to you and understand your needs and what it is you're investing for. Some people might, as I'm saying all this, might accuse me of biased advice. They'll say, of course you recommend a fee-only investment advisor. You are one. And I tell them, I've recommended fee-only advisors before I became one. So that would be my counter argument. I'm a tenured professor here at Eastern Illinois. I don't need the income from Lach Financial. I do it because I tell clients it's a passion of mine. I love to do it. And it's also, I tell people I teach and I work with clients, and what I do in the classroom really helps me with clients, because when you're a teacher, you can't just know 20% of what you're teaching. You have to know all of it front and back. And so that helps me when I work with clients. And working with clients has really helped me in the classroom. So it's given me some good, real world examples that I could bring into the classroom and bring to students. And it really brings the material to life for the students. So it's been mutually beneficial. But when I started my own firm, it wasn't an instance of, I had to pick this one business model because it's the only way I was going to get a job. I had the luxury of picking whatever business model I wanted because my income here at Eastern pays more than enough to keep the lights on. So I picked fee only because I think it does the most to mitigate conflicts of interest. And I decided to form as a registered investment advisor because I wanted to make a commitment of putting my clients first. So yeah, some people might say I'm biased, but that's why I'm a fee-only registered investment advisor. So those were some of the questions my students had. People will often ask me, how do I evaluate a mutual fund? And so I'm a big believer that when you're an investment advisor, I think it's a tremendous responsibility. And I'm a big believer that everything you do as an investment advisor, you should be able to tie back to academic theory. Sadly, most people in this business can't tie anything back to academic theory. So everything I do, I tie back to academic theory. And what are the things the academics have told us? Well, when it comes to mutual funds, the academics have found that lower expenses translate to higher returns. Common sense. But it's not the way we would expect, because we're told you get what you pay for in American culture, right? We're told if you pay more for something, it's going to be better. But there's one particular research study, and what they did was they looked at different mutual funds, and they looked at the expense ratios of those funds. They found that on average, so an expense ratio when you buy a mutual fund, they need to make money somehow to pay for the managers, to pay for overhead like their corporate headquarters, support staff, etc. So every mutual fund company has to make money somehow. And they make that through an expense ratio. And an expense ratio is a percentage of your investment in that mutual fund that comes out for fees. So this academic study found for every 1% increase in a fund's expense ratio, you would expect, if managers added no value whatsoever, and they were neutral in this picture, you would expect a 1% increase in fees would reduce your expenses by 1%. It's not what this study found. For every 1% increase in fees, performance dropped 1.4%. Meaning not only do these high expenses hurt your bottom line since it's money coming out of your account, the more expenses a manager is charging you, the weaker your returns are going to be. And there's another paper called The Arithmetic of Active Management, and I'm trying to remember who it was. I want to say it was Bill Sharp that wrote it, but it might have been somebody else. The person that wrote it received a Nobel Prize in economics, not for this study, but as a Nobel Prize recipient. And the argument in the paper was very basic. So as an investor, you could be active or passive. Passive, we're taking the approach, if we can't beat them, join them. Active, we're taking the approach, we want to beat the market. We want to get the highest return possible. We want to maximize value for our investors. The passive people say, there's a market out there. Let's create a portfolio that's a tiny little sliver of that overall market. With students, I'll sometimes use the analogy of a cake, right? You have different layers to the cake. And my analogy of passive is it's kind of like cutting out a little piece of that cake and letting everybody else fight over the rest, right? Some people might like more icing than others. Some people might like more ice cream than others. And so they'll divvy up that cake in any way that maximizes their own taste. But by cutting a little piece out of that cake, our little piece has the same characteristics as what's left over of the cake. So while some people might get more icing than others, some might get more ice cream than others, we are getting, the percentage of ice cream in our cake is the same as what everybody on average is going to have. So this philosophy with passive management all comes down to law of averages. I'd use the analogy, if you're at a wedding reception and there's 100 people there, and the average height of all 100 participants is 5 feet 6 inches tall. Now say if 5 of them go outside to have a cigarette, and the height of those 5 people is all exactly 5 feet 6 inches tall, how tall are the other 95 people in the wedding reception? They're 5'6", right? It's the same principle with passive investing. We're going to take out a little sliver of the market that has the same characteristics of the market. That means that the active managers, by definition, all of them collectively will get the same returns as passive investors. So this passive versus active decision, trying to beat the market versus trying to mimic the market, I tell people you have to understand that before fees, the passive and active people as a group are going to tie, right? By definition. But there are fees. Weighted average expense ratio for a passively managed mutual fund, and this is what is argued in the paper, The Arithmetic of Active Management. Average expense ratio for a passive fund, 0.13. Average expense ratio for an actively managed fund, 0.88. So since there are fees, on average, the passive investors will outperform the active investors by 0.75%. That's huge over time. You compound that over your working years or compound that heck over your retirement years. That is a big difference. So that's why I'm purely a passive investor. It's also why I'm a big advocate of the fee-only approach to investing. Because the only way we can get those expense ratios down to 0.13 is we can't pay a salesman a commission. Right? So that's the other problem I have with the commission business model. Not only does it create conflicts of interest, but the standard commission for a stock mutual fund is 5.75% right off the top, which means you put $100,000 into that fund, the salesman will get $5,750 right off the top. So it's really hard to keep expenses super low when 5.75% comes right off the top. So that's the other reason I don't like this commission model of providing advice, because it's immediately driving those expenses up. So I look for funds with low expense ratios, because low expense ratios in passive investing usually go hand in hand. You will still find some passive investments that charge high expense ratios. I've seen funds, and they're called index funds typically, because the funds seek to mimic some index, right? The S&P 500 would be the most common index. So I've seen some S&P 500 index funds with an expense ratio of 0.9% or 1%. And so once you get into those high fees, it's mitigating that big benefit of passive investing. So that's why I'm a big fan of passive investments. And so where do you find all these fees? There's a website, morningstar.com, and it's probably the easiest way to go to evaluate a fund. Again, I'm not recommending any products here, but just to give you a very basic idea of what I look at if a client comes in and we're doing a portfolio review. I've been doing this long enough to where tell me the name of the company and I could tell you if it's actively or passively managed, typically. But there's still some, there's so many different fund families out there. If it's one I'm not familiar with, I'll go into Morningstar. And mutual funds will have a 5-letter symbol. You know it's a mutual fund because it ends in X. And if you're looking at your statement, you could look at that 5-letter symbol. It's called a ticker symbol. Or you could just search by the name. In fact, with this particular fund, I couldn't remember the name of it, so I just searched by name. So here we have a fund. 2 numbers I look at right away. The first is load. This is the commission that you're going to pay a salesman, and it's expressed as a percentage. So if you went to a salesman with $100,000 and the salesman put you in this fund, $4,750 comes out right off the top. So you're not putting $100,000 into this fund, you're putting in $95,250 into this fund. Not recommending this product, just as an example. The expenses, 1.59%. So on top of this 4.75% commission, 1.59% would come out of this fund to pay for this company's overhead. There's another number I'll often look at, and that's turnover. 256%. That means this mutual fund takes its holdings, on average, sells all of them, and repeats that 2.5 times in a year. All right, so it churns through its investments 2.5 times per year. The problem with that from an investor's perspective is whatever the mutual fund does flows through to you. So if they have short-term capital gains, you have to recognize those on your taxes if it's in a fully taxable account. The problem is short-term capital gains are taxed at your marginal tax rate. Long-term capital gains are taxed at 15%. So if you're in, say, the 25% tax bracket, short-term capital gains you're paying 25% in taxes. Long-term you're only paying 15%. So those are 3 numbers I'll look at right away. There's a lot of other stuff I'll look at when evaluating a fund, but with those 3 numbers, a lot of times I could end my evaluation there. 1.59%, that's very high. Let's look at another one. Again, I'm not recommending any of these, but it depends on the asset class. So, for example, let's see. For example, if we're just looking at large American companies, this has an expense ratio of 0.16, which is pretty low. International stocks are going to have higher expense ratios. And again, these are all large companies which have lower trading expenses. If you get into small company stocks, which I recommend because small company stocks historically outperform large, there's a lot of academic research which shows that. Small company stocks usually have higher expense ratios. So a domestic small company stock fund, you might be looking at 0.4. International small company stock, it could get up to 0.7. But if all you have are large company stocks, that's what this large means. And Morningstar will also have a little style map here, which is also derived from academic research. Fama and French wrote a paper that shows these 2 things will explain about 95% of your portfolio's returns. So Here we have the size. So this is a large stock fund. So large stock funds, the expense ratio should be a lot lower. Small stock funds, the expense ratio will be higher. And international funds will also have a little bit higher expense ratio. But again, a standard middle-of-the-road large cap stock fund, it shouldn't be more than 0.2%. And in my opinion, it shouldn't have a load either. So this Vanguard fund, again, not recommending any products here, just for comparison purposes. There is no load. So you don't have to pay a salesman a commission to get in this. And when I'm evaluating products, that's one of the things I look for. I don't want to see a load. One, because having to pay out that load reduces the amount you're putting into the investment. The other reason is my philosophy is, if an investment is so great, why do they have to pay a salesman to push it? So load, none. Expense ratio, 0.16%. So lower by more than a factor, or lower by about a factor of 10 relative to the other fund that we looked at, which I'm not recommending this one or the other, just comparing. And then the other thing I look at, turnover, 3%. So only 3% of this portfolio gets turned over every year. That low turnover is going to help the investor on their taxes if this is in a fully taxable account. If it's in an IRA, it's kind of a moot point. But if this was in a fully taxable account, very low turnover means most of your gains will be long-term gains, which are taxed at a lower tax rate. So that's a very quick and easy way to evaluate mutual funds. The lower the expenses, the better. Again, I used the phrase in an earlier presentation today, fishing out of the same pond. Right? The active and passive people are all fishing out of the same pond. So on average, collectively, their returns will be the same. The only thing we can control are the fees. And so that's why I look for low expense ratios, and I want to see no load when I'm evaluating an investment. Doesn't mean I'm automatically going to pick it. There's other things I'll look at as well, but man, those two things, it's a huge part of the battle. Huge part of the battle. So those are some of the basic things I'll look at when I evaluate mutual funds. And I don't evaluate stocks because twice the risk, the exact same return, on average, is a diversified fund like this. And just for illustration, I'll show you the number of holdings in this fund. Stock holdings, 3,705. It's pretty diversified. So, again, I don't do individual stocks. I will invest in mutual funds. And what I just showed you, just realized I hadn't had this maximized. What I just showed you are the three things I look at right off the bat. If it's a fund family with which I'm not familiar. Vanguard, I'm very familiar with. I wouldn't do this much analysis. If a client was bringing in a portfolio, if I looked and saw Vanguard, I'd say, okay, you're in low-cost, passively managed investments, which is good. But if it's a fund family I'm unfamiliar with, I'd go to Morningstar, I'd search by name or the ticker symbol, and I look at load, I want to see none. I look at expenses, I want this number to be low, and I want turnover to be low. By the way, returns, I don't look at those. Right? Returns are driven by asset allocation. So I don't make my decisions based on past returns. I make my decisions based on expenses and the asset allocation structure of the portfolio. And the asset allocation structure is way beyond the scope of an hour-long presentation. Honestly, I could probably do a 3 credit hour course on what I look for and why when I construct portfolios. But it's a very quick and dirty way to evaluate your own portfolio. So, any questions?
Well, you had talked about you weren't pleased with what the university has to offer.
Mm-hmm.
Was that in the 401k options?
Yeah.
So what about the 403b?
Well, there's the 401a is, I think, technically what we have here. And the reason I don't like the options, very few of them are below 0.2%. Most of them are in the 0.8, 0.9% range, which, in my opinion, since there are lower cost options available, maybe I shouldn't say this, but I'm going to say it. I believe the university has violated their fiduciary obligation to the employees by offering those high cost options. That's my professional opinion. So, yeah, if you look, I think in the EIU's plan, we have maybe 2 funds that have low expense ratios. Everything else is in that 0.8 to 1.2% range in expense ratios. And that's why I don't like them. So I think it's silly to have those when there's lower cost options available. And I don't know why the university doesn't put those lower cost options in there.
Is there a good, so what I'd like to do is really take a thorough inventory financially. So whether it's related to retirement planning, insurance, like is there a resource tool or something you'd recommend since, all right, for your insurance policies, take a look at these for your
Not that I'm aware of. And the problem with looking for online resources is there's so much out there, a lot of which is not accurate. There is a paper, and I haven't had a chance to read it yet, about online financial calculators, online retirement calculators. Some people went through and back tested to see if they were accurate, and a staggeringly large percentage were not. And so that's where, I know it sounds self-serving, but that's where I think it's good to go with a fee-only investment advisor and going through and taking inventory that way. Because there's so many other people and so many other websites that all have hidden agendas, and that's where I think a fee-only advisor is going to be your most objective source. They're not going to have any hidden agendas other than maximizing your benefit. But I'm trying to think of some resources that are good, where you're going to get some pretty objective advice. There's one site, bogleheads.com. Bogleheads, it's named for John Bogle, the founder of Vanguard. He was the pioneer in passive investing. And so they call themselves Bogleheads. I guess Jimmy Buffett fans are parrot heads, so John Bogle fans are Bogleheads. They have a pretty good forum where I believe there are some fee-only investment advisors that will participate, and a lot of people on there that participate are fairly well-read on the topic. Again, I haven't been able to thoroughly vet it, but in terms of just going to a website and kind of looking for some options, Bogleheads is a good site.
You were talking about credentialing.
Mm-hmm.
Major investment firms,
Mm-hmm.
Staples and Edward Jones.
Mm-hmm.
I was assuming that if we were working with one of those groups, that their corporate responsibility for their training and their certification was no? Okay.
There are no formal education requirements needed to become a broker or an investment advisor in most states, which means if you're a high school dropout and you could pass your Series 7, you're good to go. And
my business card, my investment executive, I'm not sure what that is.
the only regulated term is investment advisor or investment advisor representative. So, for example, in the state of Kentucky, they will not let an individual call themselves an investment advisor. In Kentucky, the firm is the investment advisor. So Lach Financial is a registered investment advisor. Patrick Lach is an investment advisor representative. Those are the only 2 titles that have any weight whatsoever. The other thing is there's a lot of people, there's investment advisors that are fiduciaries, there's brokers that are salesmen. What a lot of people will do, and this is something that to me is very disturbing, is they will be they'll have what's called dual registration, where they're both. The frustrating thing is they won't tell, the clients never know when they're wearing their fiduciary hat and when they're wearing their salesman cap. Usually what dual registration, what it means is they will prepare a plan that is in your best interest. They will be an investment advisor, learn about your goals, and the plan will be in your best interest. Then they'll take off that advisor hat and put on their salesman hat and implement the plan with high expense commission-based products. So I'm not a fan of dual registration. It's become really the most common. I'm working on a research study and had my GA for a large, or not a large, but a metropolitan area, picked the state capital, 25-mile radius, and had him search for all the CFPs within a 25-mile radius. And I had him go to the Securities and Exchange Commission and look how they were registered. We found 44 names. Of the 44 names, 40 were dual registered. And I think only 1 or 2 were pure fee-only registered investment advisors. So the easiest way to find out if they're a fiduciary is to get it in writing. And if they won't put it in writing, run. Right? You know, in the cartoons, when somebody runs away, there's a hole in the wall the shape of that person. That should be you if they won't put in writing that they're a fiduciary at all times. So, but that's my opinion. I wouldn't give my life savings to somebody that's not working in my best interest at all times. Because the dual registration, I don't think a fiduciary standard is a hat you could take on and off. I remember overhearing a student and they made the comment, I'm a vegetarian 90% of the time. I wanted to say, you're actually a vegetarian 0% of the time. And I feel it's the same way with a fiduciary standard. You're a fiduciary 100% of the time, or you're not a fiduciary at all. And that's my problem with dual registration. It's not a hat you could take on and off. Any other questions? All right. Thanks for your time. Hope you enjoyed it.